Lyft is on a wild ride today after reporting quarterly earnings that beat expectations. The ride-sharing company posting an adjusted loss of 68 cents a share on a revenue of $867.27 million. And joining us now to break things down is Manhattan Venture Partners' Santosh Rao. Santosh, thanks for taking the time, sir. When we talk about Lyft, it's interesting just because, a lot of people have been questioning the path to profitability. After this quarter, Wedbush Securities upgraded Lyft. We saw a swath of price targets being increased here. Is the quarter guidance that they gave enough now for you to expect a true path to profitability?
Absolutely. I think the path to profitability just got more clear. It's still a long way to go. This is a long-term story. These are storied stock. You're talking about a transformational stock, transformational industry. So it's going to take a while. But as long as it's going in the right direction, what you saw this quarter was a classic beat and raise quarter. All the metrics that matter did well. So I think that's good. So it's moving in the right direction. The bigger thing is to watch for. I mean, Uber's coming out tonight. They took market share, it looks like. So did it come at the cost of Uber, or did the market just grow? So we need to see that. So I think that's a big thing tonight.
Just want to dig into one more number. Lyft also boosted its full-year guidance well above where the Wall Street estimates were, guiding more towards a full-year EBITDA loss in a range of $850 to $875 million versus the Street's expectation of $1.15 billion with a B. Obviously, that's big. Obviously, that's moving the stock today. But to your point, as we see Lyft kind of increasing its path to profitability, it's not the same as Uber, since Lyft is so focused on the U.S., and you see that as a plus.
Absolutely. I think that's the reason why we invested. My capital markets group invested in this stock, because a pure play has its value. And in this cash-rich business where it requires a lot of cash, I think to manage those resources is very important, more so as a public company. So Lyft is very focused in its strategy. It is managing its resources well, and it's just going on. North America is where the ride-sharing business is going to be decided, who wins. That's where the profit is. That's the growth engine for both. And I think Lyft is doing the right thing. It's growing very well.
Santosh, should Lyft or should Uber be terrified of Lyft? I was on the Lyft conference call last night. They seem to be inking a lot of new deals that I don't hear from Uber. A company like Hilton, a company like also teaming up with sports teams. I'm not hearing that from Uber at all.
Absolutely. I think that's been a strike against Uber. Lyft has been very innovative.
And more aggressive.
More aggressive, because they can. I mean, they're very focused. They're using less of their money. They're investing much better. I think they're just doing the right thing. And they've always been innovative, like, coming up with tips in the beginning, the shared rides, and all these things. They've always been like one step ahead of Uber in terms of innovation in this space. And that's what I think in the beginning they said that, and when we got into this stock, we knew that. Now they're rationalizing the pricing, they're rationalizing the incentives. There's a lot of slack in the model, so they can really cut down more. The insurance costs they've talked about a lot, they can cut down quite a bit. So they can still get more operating leverage out of this model, and they're doing the right thing at this point.
Now, there's been some uncertainty about the fact that the lockup period is actually going to end sooner than most investors realize. Is that something that investors should be worried about, or an opportunity that somebody should take advantage of?
Opportunity that someone should take advantage of, because that's really a technicality. I mean, just 1 month earlier, that's fine. It doesn't matter. We knew that, and when they came out, when they did the IPO, we knew how many options were coming out, how many stocks were coming after lockup. So not a big issue. It'll settle down. Normally, when the lockup expires, there's a 5 to 6% drop here and there. In the past, we've seen that with our portfolio companies. So I think this will happen, but it's a great entry point for people to get in, because this is a long-term story.
So prep for about a 5% change there. But the other thing that they mentioned in the earnings call, they repeated this phrase quite a bit. They kept saying that the market conditions continue to improve, which you could argue would also be a plus for Uber, since we talk about price competitiveness between these two names. We're seeing the move higher in Uber. We're seeing the move higher in Lyft. Is that important to you when we talk about how competition between these two names had really made it not so likely that they may reach profitability now? If that pricing pressure isn't there, obviously a plus moving forward.
Absolutely, a great plus. I think that was a big negative. The bear case on this whole industry was, how will they make money? The prices are so low, the costs are so high, the take rates are fixed. So how do you make money? But this company showed this today, and Uber might show tonight, is they can make money. there is a path. They can rationalize everything, the incentives, target better all the incentives, and that's what they're doing. So there's a whole market. But just remember, overall, they have just tapped into a very small piece of the whole market. The addressable market is in trillions. They're just hardly 10 to 15% of the whole market. So long way to go, and well positioned.
Long way to go if you're a long-term investor. You're willing to stomach some busy rides there. All right, Santosh Rao, thank you so much.
Thank you. Thanks for having me.
Appreciate it.